Today is Monday, November 11th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Alan Bush, ADMIS Senior Financial Economist, and Mark Bowman, ADMIS Senior Global Market Analyst. And starting with the grains this morning, Mark, USDA reports this Friday. You expecting any surprises?
Well, a couple things jump out from last Friday's report. First off, soybean production. Production was cut 121 million bushels to 4.461 billion, with an average yield being slashed to 51.7 bushels an acre. The USDA had been forecasting record yields and record production. That's no longer the case for either. In addition to that, the 121 million bushel cut was the largest drop in the month of November since at least 1990. The USDA has now cut production in September, October, and now November, and that's only happened 4 times since 1990. 3 of those years, final production was below the November forecast, with 1 year being above it by a little bit. So history would certainly argue that final production will be below Friday's forecast, and in my opinion, it will keep prices supported above the $10 level through year end as we just continue to monitor South American production prospects and any sign of recovery here in Japan following recent stimulus efforts there. The other thing that jumped out was just a lack of change in demand estimates for both corn and in soybean oil. The USDA kept their export forecast the same for both, and that despite corn export commitments up 48% year over year, while the USDA forecast is only up 1.4%. And in bean oil, the current commitments after last week's huge sales announcements that represent 86% of the USDA forecast for the entire 24-25 marketing year, just 1 month into that time frame. So we'll continue to monitor the pace going forward, but right now I got to lean towards higher exports on both. And in soybeans, I think we'll see higher crush numbers as well as strength for bean oil continues to be strong.
And Mark, where are the large spec traders positioned grain-wise currently, and are they having any impact on the market?
Yeah, they have, Kurt. First off, in corn, we've seen a big shift from a record short position just 4 months ago by the money managers. Now, they have flipped that around. Now, they have a little bit of a long position now for the first time in 15 months. And in soybean, similar situation, although not to the same degree. They're still short a little bit, but well off the record short here from July. We've seen prices recover in both, and obviously, I think the speculative trade has had a big part of that. And I think a lot of the evening up here was likely leading up to this U.S. election. Now, with that out of the way, I think we'll continue to monitor weather situation in South America and just to see how U.S. and Chinese relations go. If we slip back into another trade war like we saw under the last Trump presidency, or if the incoming administration can convince China to perhaps better balance their commodity purchases between U.S. and Brazil. And in soybean products, we've seen a big shift in buying in soybean oil and selling in the meal. Global vegetable oil prices have been on a tear due to strong demand for biofuel production. We've recently seen palm oil prices hit a 2-year high. Money managers now have built their long position in soybean oil to over 63,000 contracts. That's the largest in almost 2 years. And in the meal, they've flipped that around and gone short now for the first time in 7 months. So I think we'll probably see a little bit of a correction in this oil meal spreading, but I do expect that trend to continue. Stronger bean oil prices while being weaker in the meal.
Always good to keep an eye on what the spec traders are doing. Mark Bowman, what's ahead for the sugar market this week?
All right, well, the Brazilian trade group Wkly releases its bi-monthly sugar production report this week. They'll probably do it before Friday, the 15th. We usually get notice of that via email the night before the report is released. And this one will be for the second half of October. Wkly reports cover Center-South Brazil, which is their main production area, and a pre-report survey has expectations around 1.69 million tons for that period, which that would be down 28% from the same period last year. And if that comes in at that level, it would bring the year-to-date total to just about even with last year. As of October 16th, the previous report, cumulative production was 35.591 million tons, which was up 1.9% from last year. And we've had this trend since the middle of summer of the surplus to year ago narrowing in most of the reports. We started out really strong because dry conditions led to fast harvest, and they were ideal for harvest, but they were not necessarily good for the developing cane crop. So it's been long expected that we would gradually start to see production slip behind a year ago, and it looks like it's taken till now to have that happened. Another important number to watch will be ethanol production. It's currently running about 8% ahead of a year ago, and for the first half of October, 52.7% of the center-south cane was being used for ethanol production versus 47.3% for sugar.
Mark, as we look at the cocoa market and especially how the crop is doing in West Africa, what can you tell us there?
So we don't get a lot of consistent data on cocoa production in West Africa. It's not like U.S. grain production or actually grain production around the world where there's just regular updates. The ICCO produces quarterly updates, but they have yet to do a forecast for this coming marketing year. That'll come in the next quarter. But so what we have are Ivory Coast arrivals is probably one of the best numbers we can follow. And those are weekly numbers. It's kind of casual. It's a survey done by Reuters usually. And but arrivals for the week ending Sunday were 90,000 tons, which was up from 80,000 last week and up from 63,000 from the same period a year ago. And cumulative arrivals for the marketing year, which began on October 1st, have now reached 455,000 tons, which is up from 290,000 for the same period a year ago, and the highest for this point in the season since 2020. The 5-year average is 379,800 tons, so we're even above the average. And they are running about 65% above where they were than last season. Though that suggests a strong start, but we've had periods of heavy rain this fall that have raised worries about how we're going to do later in the main crop production cycle. Prior to this, growers had expressed optimism that they would produce 2 strong crops per month between October through December. But now, last week, sources inside Ivory Coast's main regulating group, the Ivory Coast Coffee and Cocoa Council, said total arrivals were only expected to be 1 million tons by the end of the January, which would be similar to last year, which was a disappointing crop, and would be down from an average of 1.326 million for that period. So we'll have to see whether that wet weather really caused a problem or not, because otherwise periods of sunshine and rain are good for production. And we hear things like, oh, the rain was good for growing conditions.
Thanks, Mark. Alan, last but not least, what's your price outlook for financial futures in light of the recent presidential election outcome?
Okay, so the U.S. dollar index is likely to continue to trend higher, since it appears more likely now that the Federal Open Market Committee will be slower to move to accommodation after the election results compared to what was previously believed prior to November 5th. So while the Fed may be slow to lower its Fed funds rate, it appears more likely that other central banks will be lowering their key rates at a more rapid pace. That would include the European Central Bank and the Bank of England. So this is a recipe for additional strength in the greenback. Stock index futures have advanced to new record highs this morning, and this appears to be inconsistent with the belief that the Federal Open Market Committee may be slowing its easing pace. So it appears that some other more dominant fundamentals are at play here that are overriding the negative influence on a potentially less accommodative Fed. So with stock index futures now at new record highs, we have the technicals, of course, remaining supportive. So it is likely that there will be some follow-through strength in stock index futures. And in the interest rate market futures, the fundamentals have turned slightly bearish for futures at the front end of the yield curve and are neutral for futures at the long end of the curve, especially the 30-year Treasury bond futures. So not a lot to do in the interest rate futures markets, but I think a lot to do in the currencies, with the dollar likely to advance, other currencies, the euro currency, the pound, the yen likely to come under pressure. And of course, stock index futures will probably see some follow-through strength.
And Al, in the week ahead, what major reports will traders be watching?
Okay, on Wednesday, we'll have the October Consumer Price Index that's guessed at up 0.2%. Thursday, the Producer Price Index anticipated to also be up 0.2%. And then on Friday, October retail sales, the guess there is for an increase of 0.3%.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.